So let's talk about what makes up your payment, some tips and some hacks for you to consider when thinking about things. First, I wanted to break down, people often ask, like, what makes up my payment? What is it? And there's a term or industry jargon that gets thrown around. Your pity payment is what your mortgage lender is typically going to be talking to you about. And it covers most everything. It covers over 90% of the situations, but it doesn't cover all of them. So I'll talk about those couple outliers as well. The first thing pity stands for, it's an acronym. It stands for principal. That's the amount of the loan that is paid off monthly. Then the I is for interest, the amount of interest that you pay monthly. Combine those two and you get the PI part of the pity payment. T is for taxes. Property taxes are paid 2 times a year here in Washington, April and October. But the taxes, most people put them into the mortgage. That's a suggestion that we have, that you just put it into the mortgage payment and you don't have to think about it anymore. The mortgage takes 1/12 of the taxes every month, saves them up, pays them when it's time to pay them, and you move on. Insurance is the same thing. Your homeowner's insurance split out monthly so that a little chunk is going every month, and then the mortgage servicer pays the mortgage for you, the insurance for you when it's due. Some banks will give you a little bit of a discount, or the opposite of that, charge you a penalty. You can get a discount from some lenders, depending on how they set their pricing, if your taxes and insurance are in the payment. Other lenders will charge you a little bit more if your taxes and insurance are not in the payment, because they get more security for their collateral, right? The house is their collateral if they have to take it back. They want to know that the taxes are getting paid, because taxes are one of the only things that can jump in front of a mortgage and foreclose them out of the house. So if the house goes to foreclosure, they may not get paid back. So they're really sensitive to taxes. And insurance is the thing, because if the house burns down and you can't pay for it, or gets flooded, or something happens and you can't pay for it and there's no insurance, you may end up just defaulting on the mortgage, and they don't want to take the house back. So they can incentivize those behaviors through how they compensate in their pricing. Put an asterisk in here for the couple other things that I mentioned that make up the other like 10 or 15% of transactions as you are looking at what consists of your payment. These don't typically fall into the payment. And you'll want to make sure that when you're talking to your lender about how much your payment is going to be, that all the things you're going to be paying every month are included. One of them is PMI, which is another acronym. It stands for private mortgage insurance. This is typically done with many low down payment programs. So things like an FHA loan, if you've heard of that, or other low down payment programs will add what they call private mortgage insurance until the loan to value gets in a different proportion, and then you can ask to have it removed. I'll talk a little bit more about that proportion in the next slide, but these are really the things that make up your monthly payment. The pity payment plus PMI plus potentially HOA dues, homeowners association, if you're looking at a condo or a planned unit development or some of the developments that are out there now.